Wondering if 2026 is the year to load up on dollars? The chatter right now might be mixed, but a closer look at the horizon suggests a powerful story is about to unfold for the US currency. It's a story about timing, and it starts with a little patience. First, let's talk about the next few months. As we head towards the end of 2025, the dollar might hit a bit of a soft patch. Think of it as a pause for breath. We could see some challenges in the American job market, some uncertainty swirling around trade policies, and even a shift in how big investors protect or hedge their international investments. This combination could create a temporary headwind, making the dollar seem less attractive for a short period. But for the strategic investor, a period of softness isn't a red flag, it's a potential starting block. This could be the setup for the real move. Because once the calendar flips to 2026, the picture changes dramatically. The forecast points to a significant rebound, with the dollar showing real firmness throughout the year. What's driving this comeback? Three key things. First, renewed economic momentum.
The American growth engine is expected to find another gear, outpacing its global peers. In fact, a key part of this forecast is the idea that the market is currently underpricing just how strong this U.S. growth advantage will be. Second, the political landscape after the midterm elections could bring policies that are favorable to the currency. And third, and this is crucial, the central bank is expected to be very deliberate about interest rate cuts. We're not talking about aggressive slashing. The outlook is for a measured, slow reduction, maybe 3/4 of a percentage point in total by the end of the year. This restraint keeps the dollar attractive to international capital. So what does this look like in practice? Against the euro, the dollar could climb by roughly 6%. We could even see the exchange rate approach parity levels, around 1.10, by the third quarter of 2026. Part of this is dollar strength, but it's also because the European Central Bank is likely to hold a steady, less aggressive course, which naturally caps the euro's potential to rise. The story against the British pound is even more compelling. The analysis suggests a potential 9% appreciation for the dollar over the coming 6 to 12 months, pushing the exchange rate towards 1.22. We're also seeing robust inflows into American stock markets, and many of these purchases are unhedged, meaning investors are buying dollars directly to participate, adding another layer of support. This brings us to the most important question. How do you act on this?
The strategy here is all about timing. The ideal entry point to buy dollars might not be today, but rather in that period of anticipated weakness in late 2025. You'll want to watch for the signals. Look for signs that the economy is finding its footing after a trough. Listen closely to the central bank's language. When their tone shifts from overly cautious to something more neutral or restrained, that's a key trigger. That's your window to position for the expected gains in early and mid-2026. Of course, no strategy is without risk. This isn't about putting all your eggs in one basket. Diversification remains your best friend, and managing your risk is paramount. So while the immediate future might show some turbulence, the flight plan for the US dollar in 2026 looks clear and confident. It's a story of patience, followed by a potential period of significant strength. Keep a close eye on the economic indicators. Don't ignore the political shifts, and as always, consider speaking with a financial professional to see how this fits into your own portfolio. The opportunity isn't in following the crowd, but in seeing where the path is leading before everyone else gets there.